I am Max Keiser. This is the Keiser Report. I know what you're thinking about. Justin Bieber, right, Stacy?
No, Max, it's Biebanke. Yes, Bernanke more popular than Justin Bieber. This, of course, if you watch CNBC. So Chicago Booth School of Business professor Randy Krosner was on CNBC, and he said that Ben Bernanke is more popular than Justin Bieber, but also responding to a question from a caller who asked about Romney's plan to audit the Fed. And he said, well, the Fed is already audited by the big accounting firms.
Well, yeah, this is Justin Bieber should be running the Fed, really, because he'd have more sense. But the fact that this CNBC clown can make this kind of statement because he thinks CNBC listeners, old 80-year-old white guys dribbling on their, front of their shirt like a Charlie Munger and Warren Buffett would be like, oh, we know Justin Bieber is, we watch YouTube. We see we're not old, decrepit, broken down, nonsensical idiots in Omaha.
You did mention Warren Buffett, so let's talk about Warren Buffett. Buffett's move raises a red flag. A decision by Warren Buffett's Berkshire Hathaway to end a large wager on the municipal bond market is deepening questions from some investors about the risks of buying debt issued by cities, states, and other public entities. The Omaha, Nebraska company recently terminated credit default swaps insuring $8.25 billion of municipal debt. Berkshire's move comes as investors are flooding into municipal debt.
Right. Well, again, Warren Buffett, the coward, pulling out, sucking all these suckers into the debt. Meredith Whitney, remember last year, said all these municipal bonds are going to toast, and everyone ridiculed her, including CNBC. Oh, Meredith, you're anti-American. You're a bad woman. And, of course, she was dead right. And all these municipalities are going bankrupt, and these municipal bonds are going to be worthless, and Warren Buffett is retreating. But he pays lip service to how great America is, and the municipalities are on TV because he's a duplicitous, lying sack of Omaha steaks.
So, however, when this was announced just this past week that Warren Buffett has raised the red flag and he's scaring everybody to get out of the municipal bond market, I recalled from June where he was praising JP Morgan's Jamie Dimon. I'm personally betting on JP Morgan and Jamie Dimon. Buffett revealed his bet during an interview with CNBC. So this is JP Morgan and Jamie Dimon. Jamie Dimon, he said, is the world's best banker. Now, what role does JP Morgan play in the municipal bond market in the United States?
They underwrite them. They're the banker.
They are the banker. They underwrote a lot of the credit default swaps, the interest rate swaps, which has since blown up. They devastated and wiped out the largest bankruptcy in municipal county history and across America, which was Jefferson County. So at the same time, that should have been your signal. That should have been your true red flag. He was waving the flag when he was saying in June on CNBC, where he goes to talk his book, that was where he was saying Jamie Dimon is the best banker in the world. Now everybody 2 months later is acting all shocked that he's dumped his municipal bond holdings.
Yeah, right. So Warren Buffett likes Jamie Dimon now. It's like the U.S. After 9/11, Al-Qaeda was the enemy. Then they attacked Iraq. Now Al-Qaeda is the rebel forces and working with America in Syria. So Al-Qaeda is the good guy now. So Jamie Dimon is the good guy now. He's the good terrorist. He's there to commit financial terrorism on behalf of Warren Buffett. But when it's not convenient, then he'll be thrown over the bridge temporarily, and then he'll be brought back. He goes from being the good terrorist to the bad terrorist, depending on what role is easily played out on CNBC, the #1 propaganda network in America.
So Warren Buffett said that Jamie Dimon is the best banker in the world. He's in the next headline. Public pension funds named to lead London whale lawsuit. Public pension funds from Arkansas, Ohio, Oregon, and Sweden will be lead plaintiffs in a group lawsuit against JP Morgan Chase over trades made by Bruno Ixel, known as the London whale. The pension funds allege they lost as much as $52 million because of fraudulent activities by JP Morgan's London Chief Investment Office.
All right, so now Jamie Dimon is the bad terrorist for the moment, and then he'll be probably given a Presidential Medal of Honor. And then there'll be an election. Then he'll be Treasury Secretary. And then, oh no, there's a big loss. Jamie Dimon's the bad terrorist. And then he's a good terrorist. And then CNBC's out there with Maria Bartiromo or whatever shaking around saying, oh yeah, Jamie Dimon, Jamie Dimon. Warren Buffett coming along to Omaha Steaks. He's great. No, he's bad. No, he's great. Oh yeah, by the way, the entire economy has been eviscerated. Joblessness is all-time high. Over 50% of the population's on government assistance. Food stamps are zooming up higher. Who does food stamps? Jamie Dimon and JP Morgan. It's a prison gulag state, brought to you by Jamie Dimon and Warren Buffett and CNBC.
And of course, this London whale happened in the City of London, through which all fraud happens. Now, in the UK, there is a dish known as bubbling squeak. I think it should be renamed bubble and fraud. In this headline here, Max, RBS investigated over possible Iran sanctions violations, according to the FT. Report of investigations by Federal Reserve and Department of Justice follows $340 million settlement by Standard Chartered. The Financial Times said that the New York State agency is not investigating RBS. It's just the Federal Reserve and the Department of Justice, who were a little bit annoyed with this new Andrew Cuomo agency that tried to, get in on their turf.
Oh, yeah. Last year, RBS was a good terrorist. So the state bailed them out. And now they're a bad terrorist. So now they have to be shaken down by Wall Street. And yeah, bubble and squeak, that is a famous dish in the UK. They should rename it bubble and fraud. And while they're at it, they should put Bob Diamond on the dessert menu. He's the new spotted dick.
Well, but this is also the problem with having an oligarchic system. We have, like the Kingdom of Saudi Arabia, we have 7,000 princes, and there's all sorts of little turf wars that occasionally, pop up in the news when they gun each other down. But, at the end of the day, there's just too many princes.
No, I think that's a great model. The Saudi Arabian prince is really the model that the U.S. is following. They've got 7,000 princes. They all need an extraordinary amount of free money from the government to keep themselves in their princely affairs. And in the U.S. now, you've got this 7,000 or 8,000 made people, like a Jamie Dimon, a prince of the oligarchy, who's given all this money freely from the U.S. government to go out there and commit acts of financial terrorism. And this is what we're having, a global Saudi model.
Well, you can't have a global Saudi model without either a flow of free cash or a flow of lots of oil. UK unexpectedly posts deficit as tax receipts plunge. Britain unexpectedly posted a budget deficit in July as corporation tax receipts plunged, partly due to the closure of the Elgin gas field in the North Sea.
The Elgin gas field? Is that related to the Elgin marbles that were stolen? Wait a minute. So, yeah, the gas is shockingly less this year than last year, the North Sea oil, because they're in huge decline. It's one of the big fields in the world. It's in rapid decline because, oil fields have a lifespan. This one is past sell date.
Well, it's threefold. There's rapid decline. There was a gas leak from, I think it was Total's field, where they shut that down for months on end. And also, there was a corporation tax introduced as part of the austerity measures last year in the 2011 budget by George Osborne. North Sea oil tax revenues fall offers glimpse into a diminishing future. So last year, George Osborne slapped a £2 billion tax rise on producers, which was almost an 80% tax rate. We invade countries if they raise their tax above 35–40%. So in his most recent budget, the chancellor revealed that the oil industry responded by cutting production by 18%, leading to a £2.3 billion drop in tax revenues, combined with many fields coming to the end of their life. This has seen output fall. A total of 1.04 million barrels a day was pumped in the year to March 2012, down from a peak of 2.7 million in 1999 and the lowest since the 1970s. So, look at this chart here, Max, of Brent crude oil prices. 1999, their peak, which was the lowest, the all-time bottom price for oil was $19 a barrel.
Well, this is what happens when the government throws money at the oligarchs and the monopolists, the oil companies and the bankers. Because when they stop giving them money, they can pull the old Atlas shrugged. They'll be like, we're not going to work anymore. We're in a gatekeeper position. We're wedged into the economy. If you don't give us more money, we'll call systemic collapse, which is ridiculous because the government, if they wanted to give away money, they should give it away to the entrepreneurs. They should give it away to the consumers. It is a consumer economy, after all. Why not help the consumers? No, that never occurred to George Osborne. He's too busy doing whatever he's doing, but who knows what he's doing. He doesn't seem to understand exactly how the UK economy works.
PricewaterhouseCoopers a few years ago, right before the financial collapse, did a study where they said that had the UK even saved any of those, 50% of those tax revenues, they would have one of the largest sovereign wealth funds in the world. They didn't save any of it. They poured all of it into housing speculation and to the City of London. So it'll be very interesting to see when all of that collapses at the same time that the global financial collapse is happening.
Right. The other end of that North Sea oil is Norway. they created one of the biggest sovereign wealth funds in the world.
Yeah.
They're laughing. You don't hear Norway going bankrupt. You don't hear Norway with huge employment issues. You don't hear about Norway going through the same problems that's going with the UK because they, unlike a George Osborne, they have prudent fiduciaries stewarding their capital and not some Yahoo, Eton, Oxford, friend of Cameron, Georgie Porgie and his bubble and fraud pudding.
And then finally here, Max, Peter Luger steak prices may soar as drought calls herds. So, in America, there's a major drought and the corn crop is failing and Americans feed their cattle corn, which of course destroys the quality of the meat. But nevertheless, Minetta Tavern charges $140 for its Côte de Boeuf for two. That's a 56% increase from May 2009 when the restaurant charged $90. Ooh, sounds like a lot of inflation in US dollars anyway, Max.
Yes, priced in silver, there's been actually a decrease.
Exactly. See, on the one hand, your steak is getting a lot more expensive in the US, 56% in just 3 years. However, it's down about 30% in silver prices. So silver traded at $14.50 in May 2009, which means it would have cost 6.2 ounces for that Côte de Boeuf for two at Minetta's. And now it only costs 4.6. So it went from 6.2 ounces down to 4.6. That is how precious metals protect you from this inflation.
That's right. You can't eat gold and silver unless you go to Luger's Steakhouse and swap them for a big steak and pay less now than you did in 2009. And I see you have some silver around your neck today.
I do. And one final comment about this to just show you how when the government intervenes, wackiness ensues. The drought prompted President Barack Obama to help farmers with $170 million in government meat purchases. Obama told a campaign rally in Council Bluffs, Iowa, "We've got a lot of freezers."
Lots of freezers, no brains. All right, Stacy Herbert, thanks so much for being on the Keiser Report.
Thank you, Max.
Don't go away, much more coming your way. Stay right there. Welcome back to the Keiser Report. I'm Max Keiser. Time now to go to London and speak with Dominic Frisby, the resident gold bug at Moneyweek. Dominic is also a comedian and sometimes a singer, including the smash YouTube hit Debt Bomb. Dominic, welcome to the Keiser Report.
Hi, Max. How are you doing?
Great. Now, Dominic, we've been talking about singing sensations in the first half of the show. You were out with a hit single, Debt Bomb. What's the song about? Why did you make it?
I made it just for fun. I should point out, actually, I didn't actually sing that. I can't sing that well. I got a friend of mine, Ian Virgo, to sing it, and then I mimed along in the video. But we made it really essentially to get the message out there of these, large debt problems that we had, and we were trying to do it through the medium of comedy, and it's done pretty well. It's had over 100,000 hits in the week, in just 1 week, so that's pretty good. I don't know how you define viral, but I suppose it's nearly viral.
Right, and you touch on some interesting themes in the song. If people were to really look at the transcript of the song, they would find some interesting themes in terms of bankers and central bankers. Elaborate a little bit.
Yeah, well, basically, I've got some friends in the States who are passionate Democrats, and they think it's absolutely horrible and they're deeply offended by it. So I feel that I've achieved something in that. But the basic themes, I suppose, outline the basic themes of Austrian economics. Governments should spend less, they should interfere less in the economy. They create all sorts of unintended consequences every time they attempt to do something. And I've simply taken Tom Jones's famous single Sex Bomb and reworded it with Debt Bomb. And I think it's pretty funny. We've set it in Congress, and I got 2 burlesque strippers in, and as I sing the song, they take their clothes off, and all that they have left on by the end of the song is 2 little gold coins revealing their essential private parts. And I suppose the theme of the song is that by the time you strip everything bare, all that's left is gold.
Great. Well, I suppose for the sequel, you might get Prince Harry. He seems to be fond of taking his clothes off these days. But speaking of debt bombs, the UK has just announced a shock deficit of over £500 million. A large part of the deficit was caused by the shutdown of North Sea oil. Now, with declining output from oil from the North Sea, what does this suggest for the future of the UK economy, especially for the City of London? How does that work out?
Well, there were two big things that made our economy strong in the 80s and 90s and early part of this century, Max. One was the exponential growth of the financial sector, and the other was the revenue generated by North Sea oil. Now, the financial sector, perhaps rightly, is in deep, deep trouble, and now we've got the declining oil receipts. So, you know, where's the economic growth going to come from? Is it manufacturing? Because manufacturing in this country is so heavily regulated, and basically we outsource everything to China.
Well, development of the North Sea oil field coincided with the so-called Thatcher Revolution. If you took North Sea oil out of the equation, with the Bing Bang in the City of London and this Thatcher movement, would it have been anywhere near as successful?
I don't think so. People always point to the growth of the financial sector, but they ignore the huge revenue that came from the North Sea. The North Sea is in decline. It's been in decline since the early part of this century. It's yet another manifestation of peak oil syndrome that's gripping the world.
Speaking of London as a epicenter of fraud around the world, it seems on an hourly basis that UK banks are implicated in yet another multi-billion or multi-trillion dollar or pound scandal. What happens if the fraud is truly shut down completely? Can the UK economy survive both the collapse of North Sea oil and the flow of fraud, which is the principal GDP booster in the UK?
The answer to that is yes, of course we can survive, but we need to dramatically rethink what we do and how we go about doing it. But, you know, I agree the outlook for finance is limited. But, you know, we are an entrepreneurial, capable people, but there's so many problems we've got with our economy, Max. The chief among them being the fact that, you know, we have too much debt, and the debt bomb, to go back to our earlier theme, is yet to explode. But yes, of course we can survive, but there's a number of things that need to be done. You know, there's a big argument taking place, not just in the UK, but around the world, and there's two essential themes to it. One is that the private sector is the route out of this, and two is that the government and government spending and government intervention is the route out of all this. Now, I happen to think that the private sector is the way we're going to grow ourselves out of this mess, but, you know, in order for the private sector to be able to do that, you know, the burdens placed upon it by excess taxation, excess regulation, and all those other things need to be rescinded.
Well, in the U.S. and in the UK, but particularly in the U.S. in the 1930s, a similar dilemma. Do you grow out of the problem of the Depression by government spending, or do you need to stimulate the private economy in some way? What was done to stimulate the private economy was the Pecora Commission, the FDIC, the Glass-Steagall Act. They cleaned up the fraud. And in the UK now, it's very much a bubble and fraud economy with no regulatory oversight whatsoever. AIG, Madoff, MF Global, the London whale trade, all happens in London. And now the problem is...
I'm not arguing with you, Max. I'm not arguing with you. I couldn't agree more.
Okay, well, let me
it needs to be cleaned up.
Let me follow up and ask you this as an interesting development recently, is that as the global economy shrinks and these banks are still voracious for money, there's a bit of a turf war going on between Wall Street and the City of London. Recently, we saw Wall Street attack a UK bank, Standard Chartered. They shook them down for a few $100 billion. Now, the Wall Street's saying, wait a minute, RBS is implicated. We need to shake them down. When is the City of London going to stand up to the Wall Street shakedown shysters?
I don't know the answer to that question, but I guess they need to. In the UK, London and the rest of the UK are like two different countries. And London is basically built on finance. And, you know, outside of London, London is quite hated by other parts of the UK, particularly in the northwest. And the financial sector in particular is loathed. And, you know, what does the government do? Because on the one hand, you know, banks and so on are in many ways the agencies of governments. You know, they control where the government money goes. But on the other hand, the people want the financial sector to be taken down. There is a massive amount of not unjustified loathing for the financial sector. We'll see what happens.
Dominic, what about the housing sector? Of course, the housing bubble in London was huge. Then we had the global housing crash. But then in London, of course, prices haven't been affected too much due to the influx of oligarch money that flows into London. But that seems to be something that's unsustainable? How do you see the housing market going forward? And secondly, what about this Olympic economic bump? Is it just a rat through a snake?
Well, yeah, I mean, there's two very big questions there. Focusing first on housing, you know, this divide between London and the rest of the UK is clearer in housing than it is anywhere else. London house prices are up 20% or even more in some cases since about 2008. I've looked at some properties that have doubled in price since 2008, since the financial crisis, whereas the rest of the UK is down 20%. So you've kind of got this kind of alligator's teeth where London's done that and the rest of the UK's done that, and the divide between the two has grown. And yes, London has benefited from the cheap pound, a lot of money fleeing the rest of Europe. There's also, you talk to real estate, I think over 20% of central London property is bought by foreigners. Influx of money from China, from Russia, from India, from Africa even. There's even an influx of buyers from Brazil starting to be recorded. So, you know, all these things have pushed up central London prices, but you drive through central London at night and it's in the residential areas, it's a ghost town. Nobody lives there. It's people's third and fourth homes. And you drive through places like Belgravia and Knightsbridge and they're dead. And I think that's a great shame. None of the locals live in central London anymore.
Now, let me ask you about gold for a second. Because of all these bubbles and fraud, people have been piling into gold. The Financial Times commentary recently attempted to debunk gold. You responded in Moneyweek. What's your response to the argument made previously by Warren Buffett and others that, well, gold pays no interest?
Well, Warren Buffett's absolutely right, and Warren Buffett's track record in investing is considerably better than mine. Nevertheless, it doesn't matter that gold pays no interest when real interest rates are negative, because you're losing money by having cash. So that argument bears no quarter. And gold, if you just look at the interest rates priced against gold, gold will always appreciate as long as real interest rates are below 2%. As soon as they go above 2%, then gold loses its luster. I must say, Max, I'm very bullish about gold at the moment. Over the last 10 or 12 years, it's displayed a repeating pattern where it has 6 or 9 months of significant rises, and then it consolidates that appreciation for the next 18 months, 12 to 18 months. Now, we've had a period of consolidation since the last move up to 1900. That period of consolidation has been going on for a year. I think we've seen the low in gold at 1520. Gold's tested that low several times. It hasn't gone through it. And I think we're going to see the old highs in gold retested perhaps before the end of the year. And next year, I think we break out to new highs and we go to the mid-2000s. I like gold here.
Right. Well, it should be noted that gold stacked up against Warren Buffett's vehicle, Berkshire Hathaway, is up. I should say Warren Buffett's stock is down about 90% versus gold over the past 10 years. So I'm not sure exactly.
Good point. Good point.
I'm not exactly sure why he's so bullish on his own stock when it's 90% down against gold. He also mentions that there's no way to value it. What's your thoughts on that?
Well, there are all sorts of different ways to value gold, but the problem is because it doesn't pay a yield, because it doesn't pay any interest, you know, that makes it hard for a value investor to value it using traditional value investing methods. But there are all sorts of different ways of valuing gold. You can value gold based on the cost of production, which is currently the industry average, I think, is somewhere around $1,200 an ounce. Or you can take US debt. I like to use this method because it gives you silly valuations for gold, but you can take US debt, US national debt, which currently sits at around $16 trillion, and you take the US gold holdings of 261 million ounces, and let's assume they're all there. And if the US used its gold to pay off its debt, the gold price would be, I don't even know, I think it's around $60,000 an ounce. Now, in 1980, it did that. The value of US gold holdings was enough to pay off US debt when it spiked famously to $850 in January 1980. Now, were it to do the same, we'd have to go, like I say, to somewhere near $60,000 an ounce, which would be very nice because silver, which I know you like, would be doing something similar.
Right, and of course, paying no interest is still better than paying a negative interest like 2-year paper in Germany and Switzerland. Finally, what about the statement people make, hey, you can't eat gold?
Well, you can't eat gold, but you can wear it, and it looks very nice. Let me just say, Max, on your last comment there about gold paying no interest, you know, over the last 12 years, it's been appreciating by an average of 15 to 20% a year. If your underlying investment is appreciating by 15 to 20% a year, who cares about 3 or 4% interest?
Right. You would think Warren Buffett would know something about total return, but I guess he's, you know, smoking dope with Charlie Munger or hiding under the couch, or who knows what he's doing up there in Oracle, the Omaha of Oracle. All right, Dominic Frisby, thanks so much for being on the Keiser Report. We're out of time.
Max, thanks very much for having me on. My first time on, and it's been a real pleasure. Thank you. I look forward to seeing you in London. You're coming here in a couple of weeks, I understand.
Yeah, we're going to sing Debt Bomb together on stage, and hopefully we'll get Tom Jones to join us. Okay, well, that's going to do it for this edition of the Keiser Report with me, Max Keiser, and Stacy Herbert. I want to thank my guest, Dominic Frisby. If you want to send me an email, please do so at keiserreport@rttv.ru. Until next time, Max Keiser saying bye, y'all.